Okay, so we are going to study chapter 9 today, and it is about option replication using put call parity. Means put and call are related to one another in some respect, and those two other uh, items that link put call parity are one is the risk-free asset and the another is the underlying. So when we have underlying and risk-free asset, their combination will make will prepare an equation which will prepare arbitrage free put call parity. So today we will study first. Mhm. So it tells us that put call parity establishes a
Sir,
relationship.
the screen is not yet shared, sir.
Oh, is it? Let me see. So the today's put call parity is, can this be? Okay. Is it shared now?
Ah, yes, sir. Now it is shared.
Okay, okay. Oh, so what had happened that I might have stopped it by mistake. So because I wanted to hide it and I might have stopped it. Okay. So this put call parity is based on that there are two more assets. One is the underlying, means the stock itself, and the another is a risk-free bond. So when these two are combined with put call parity, they prepare an equation that makes this put call for parity arbitrage free. So we will discuss that how that works, and it is not very difficult. Uh, so whenever there will be no put call parity, then what will happen? The arbitrageurs will buy in one market, and which is cheaper market, and sell the one which is expensive market. So that's what the arbitrager do. And apart from stocks, we very well know that there is that stocks are related to forwards. Means S0 times 1 plus R to the power T is equal to F0T, provided there is no income and no cost. Otherwise, we can add that as well. But for simplicity, you know very well that F0T is equal to S0 times 1 plus R to the power T, or S0 is equal to F0T divided by 1 plus R to the power T. So that's very simple. So linking that forward means substituting S0 with forward will make us put call forward parity. And then put call parity may be applied beyond option based strategies in the finance, and that is for equity and debt of a company. So we will see how this put call parity model explains what is equity, and the equity holders how they have bought a call option on the assets of the firm, and the bond holders how they have bought a risk-free bond and sold the put home to the shareholders. So that is the last chapter or last application. So that way this chapter is going to be very interesting. I will come here later on because these are completely new. So we will first study, we will solve all, and in the end we will come back here as well for your assessment. Well, self-assessment, it is means what you learn. Means you must be able to answer 100% of these four questions. So I will come back later on. So we will solve it. Okay. So put call parity, as I already discussed, that whenever option buyers they buy put, they have to put money, and when they buy call, they have also to spend some money, and that is called call premium. So and their contingent payoffs. So option application is similar to a forward, but it also involves borrowing and or lending and selling the underlying. So it talks about that It talks about, I think, about company that for how it will go for. Oh, we will come back to that. So there is no point in discussing unless you can understand it. Hmm. So for put call parity, we why I have noted this. So here we start with an example. So consider an investor whose goal is to benefit from upward movement in the value of the underlying. Means he is expecting that the stock price will go up. Yeah, but who wants to protect her investment from downward movement in underlying value. But he's also scared that what if he's wrong? So if he's wrong, the stock price instead of going up may go down. So for buying, for protecting himself from that, he will have to buy a put so that he can exercise at the exercise price if the stock market goes down. Okay. So what are the situation? At t is equal to 0 means beginning. Right now, an investor purchases a call option on an underlying with an exercise price of X, and the risk-free bond today pays X at T is equal to T. So he has bought a risk-free bond as well. So what did he buy? He bought a call and a risk-free bond. Okay. The cost of this strategy is C0, the price that he will pay. And what is the price of the bond? The price of the bond is the discounted value of the bond today at maturity. So since the price at maturity was X, so its present value will be X divided by 1 plus R to the power T, or X times 1 plus R to the power minus T. So he bought these things. How much money did he spend? He paid for call and he also paid for the bond. Okay, let's see. What does he do if he buys the put? So at T0, an investor purchases the underlying unit S0. So he paid money for S0 and a put option P0. So what is the exercise price of the P0? Again, it is X, means this X and this X are equal. So exercise price of call and put both is the same. So the cost of this strategy is P0 plus S0. And this one was C0 plus X time 1 plus R to the power minus T. So put call parity says that both these are equal. Means P0 plus S0 is equal to C0 plus present value of exercise price. Now, how does it happen? Let's see by payoff. So first of all, when you buy a option and that option is call option. So beyond exercise price means X, we had seen that the payoff was 1 to 1. Means if the price of a stock or underlying goes by $1, the price of a call also goes up by $1. When after exercise price means when the call is at the money, after that it begins that and it is at the maturity. So whatever be the maturity price at maturity, this is a 1 to 1 relationship. Before maturity, it won't be 1 to 1 because it will be discounted. So by risk-free rate. So before maturity, it won't be 1 to 1, but at maturity, on maturity day, it is the same. Now, so this is the payoff of call. Any doubt? Do you remember from yesterday's class?
Yes, sir. Yes, sir.
Yeah, there is no doubt in that. Now, when he had bought a long bond, no, long risk-free bond, that is what he has bought. So we said that C0 plus bond. So at exercise day, at maturity, this bond will pay X. Means from here it is 0, so 0 to X. So this bond will pay X because today it is less than X because it is a discounted value of X today. But at maturity, it will pay max is the X. That is what it will pay. So if we combine both these, okay, that is what the situation of this. So if we combine both these, then what will be the payoff? The payoff will be exactly like this. So let's see, what does it want to tell? It hasn't combined yet. When it wants to combine, then yeah, on maturity, long call option, this becomes our payoff of the C0 plus present value of X or present value of exercise price. So on maturity day, it will combine like this. So this is what it gives. Now we go to put. Does it give the same? If it gives the same payoff, then we will say that yeah, both are equal. So what has he bought? He has bought underlying. So underlying can be zero when the company closes. So this can be zero and it is a linear function. It goes like that. As the stock price goes up, the payoff goes up like that. And it starts from zero. What is the put option purchase? That until exercise price, if the value of underlying goes below zero, then there is a payoff, positive payoff. So when this underlying becomes zero, the buyer of put gets exercise price. So this exercise price is same as X here. Means it is also one-to-one relationship. So if we combine this up with this down, it becomes exactly equal a straight line. Yeah. And this is the price of underlying, that if it goes beyond exercise price, then there is one-to-one relationship in the payoff. So if it's now, so that way, when we combine both these, means here he is buying put and buying the stock, then it also gives the same figure, same payoff like this one. So whether we buy, means this one was cancelled out by put profit whenever if the market goes below X, and then after that if S goes up, this underlying will have one-to-one relationship with payoff. So we see that graphically it is okay. I am back. I don't know. It is raining heavily outside. So that's the reason why this internet is getting disconnected. Anyway, so I will go back and let me share the screen. I think if I have not shared, I will share again. Okay. And our recording is going on, no? Yes, recording is going on. So what I was discussing, that the equation of both P0 plus both give the same return, same payoff, like the graph final sum of long call and present value of exercise price gives you this payoff, because exercise price becomes here, and same with here, that whenever there is a market is going down, this part is covered by the put, so put purchase. So that way this line from 0 to exercise price is horizontal, and after that payoff. So for put, this payoff comes from underlying price increase, and for call, this payoff comes from again underlying price increase, which is converted into call price. So that way we get this equation that P0 plus S0. Where is this equation? Okay, we haven't got it. Probably it is written later. P0 plus S0 is equal to C0, means call price, plus present value of exercise price. And that we can call also as a risk-free bond. Risk-free bond with face value X.
Sir, what is the meaning of the fiduciary that's written there, sir?
Yes, fiduciary call, yeah, that I was going to explain. So fiduciary call is C0 plus that present value of bond purchase. So when we buy a risk-free asset whose face value is exercise price and call, both, then it is called fiduciary call. And when we buy S0 plus P0, means stock or underlying and put also, then it becomes protective put. What does it mean? What does it mean? Protective put means put is protecting to the fall in the value of the stock. So when you buy the put, then you can always sell your stock at exercise price if the price of the stock has fallen down below and has gone below exercise price. So that way, your stock is protected from falling prices. So that's what is called protective put. And fiduciary call means what? As a duty of financial honesty. So that is what it is. So why it is called fiduciary call means it has been supported by, it is not naked call, but you have supported it by buying a bond up to the exercise price. But it is still what I am saying, the loss can be unlimited, because if the call price goes up very high, the loss can still be unlimited, but some money, the bond, which will mature at X, that has still been protected as a credit risk. So that's why it is called fiduciary call. It is reducing some risk, some credit risk of call seller. Okay. So it is comparing with two portfolios. So one portfolio is sold call option. So earlier this graph was for bought call option. Means we had bought call as well as the risk-free bond. Yeah. So this graph is for that, and this graph is for we had bought put and underlying. So what if we sell it? So how will it be? How will it go? That is what this graph shows. Though it is not very difficult, somewhat just opposite of that you can yourself derive. But let's study this as well. So protective put has been sold. Portfolio to protective put payoff. Well, it is not okay. Protective sold. Okay, so it is for the. He should have written here. Sold. It should be actually this word should have been added. Then that would have been better. Means it is writing protective put. Now it can be long or short. So we should write here in short protective put. So short protective put means you sell the put and you sell the underlying. So when you sell the put and if the price goes below exercise price, you will start incurring loss, and that loss comes here until this underlying price becomes zero. So that is the maximum loss that you can have. The maximum loss is the exercise price that you can have if you sell the put. Is that clear? And then here, long risk-free bond means you buy long risk-free bond. Okay, so this one is somewhat different strategy. Sold put plus long risk-free bond. We had this that buy put and buy the underlying is equal to buy call and the risk-free asset or risk-free bond. So here it is telling sold the put and long risk-free bond. Is it adding plus long risk-free bond? So what happens? So when you sell the put, you get some money, and that money is from S to X. So you are getting some money, and then you have bought the risk-free bond. So what will happen? If S goes down, so your loss will start from here. It won't go here because here you have bought this risk-free bond, so this loss will be covered. So this is the portfolio for sold put plus long risk-free bond and covered call. It is not a fiduciary call, but covered call. So the difference between fiduciary call and covered call is that in covered call is defined as you buy the stock and sell the call. So that is the call has been covered by the stock purchase. So that way there is no credit risk. And if the call price rises, your stock also rises. So you are solvent. So that's why it is called covered call. Covered call means there is no credit risk in the call. The seller of the call also owns the underlying. So in that case, the buyer of call is protected from credit risk. So in covered call, the underlying is sold. And okay, so what is it 1 to 10? Let me write this equation. And then we had discussed that P0, yeah, or I should be write P0 plus plus S, sorry, plus P0 plus, no, is that what I am writing? P0 plus S0. So S should be big S0, means that the underlying, and P is the, normally we write it in a small letter. So S0 is equal to C0. So I have written O here. So let me write it like this, plus, or well, 0 should be the better word. So why write O? C0, and this one is P0, means it is for time, 0 time, plus present value of X. That is what we read. We have this. This is called put call parity. So let me write it in the top. This is put call parity is equal to. Okay. Now this has changed. It is telling short put. So short put means P0 is minus and long risk-free bond, this one. So what he has done, that he has brought P this side and C this side. Sold call option and long underlying. So what happens? If we do S0 minus C0, okay, is equal to, same thing, is equal to present value of X. No, so PV X and minus P0. So there is nothing great. You both are engineers, so you know this equation very well. It is a child's play for you, and it is showing that is the return. That's it. So both are giving the same final return. So this one is called covered call, and what is this called? No name. This is called buy risk-free bond and sell the put. So that is what you can easily write it, that if you have this covered call, what is its equivalent in the put market? So it is present, means you buy, present value of X is buying risk-free asset now, because the one which doesn't pay any coupon. So you will always get, if you buy any risk-free asset without coupon, you will have to pay this present value. And X is the exercise price. So if you buy a bond whose face value is exercise price, you will have to pay this price. So it is telling that whether we use the upper equation or the lower equation, the payoff will be the same. That is what we are showing. So nothing great here.
Sir, in the long underlying graph, why do we have X to be up over there, sir?
You mean long under which figure? This figure or lower figure?
The lower figure, sir.
Okay, in the lower figure. Okay. Long underlying. So we have this, no? Long underlying.
Yes, sir.
This one is correct? That it is one-to-one relationship. Now, why it is not starting from zero? Because you have sold call and you have got this much of money. So your underlying will actually is actually starting from here, no? It is actually starting from here, and this part is your C0. That is what has been sold. So the C0, this is the price of the call that you have received. So that's why it is not starting from zero. Yeah.
Sir, but can you go to the previous page graph, sir?
Previous page graph. Yes, sure, I can go. Yeah. Here.
No, sir, the previous one. Yeah, sir.
Here.
Yes, sir. Here it is starting from zero. Why, sir? Here the
Which
long
one?
underlying.
The long underlying, no, yes, because you have bought put also, no? You are long risk-free bond. Yeah, you are long underlying and long put as well. So you haven't got any money. So that's why it is starting from zero. Because you are long put also, no? Means you are paying money from yourself. So you are paying this put, and the put has zero value below this price. Below
Sir, but
exercise value.
since we are longing the put option, we would have paid a premium to it, right? So that also
Yeah,
should not start from zero, right?
it will start from below zero.
Ah,
Oh, because it has zero value, no? If the put is out of money, then it has zero value.
sir, but
Here
then,
you are receiving the payment, no? Okay.
yes, sir.
Okay, so here the put will be active only when you have this below price.
Yes, sir.
So yeah, so that's why since it has asymmetric payoff, means either it is minimum is zero and max is the premium that you receive.
Yes, sir.
So that's why it is starting from here zero. So long underlying, you have not received any money from anywhere. Rather, you have spent more money, but that money is useless at maturity, because if it is your out of money, then it is out of money. The call premium that you receive today, it will remain in your pocket.
Mm.
Whether it is in the money or out of the money, it will remain in your pocket.
Yes, sir.
But put at expiration has zero money if it is out of money. So that's why it is starting from zero.
Oh, sir,
And
it is not actually starting from zero, sir. It is starting from a negative point only.
yeah, it should have started from
Yeah,
negative point of
negative point.
view. Yeah,
Yes, sir. So
yeah,
the same graph only, sir.
yeah, same graph. You can say that if
Long
you,
underlying is same.
yeah, but then it has been protected from here. No,
Protected at the
yes,
that part, and in the other graph it is protected in the opposite side.
yes,
Yes, sir.
that's right.
Mm.
So this triangle and this triangle have the same area, and that's why when we combine these, we get
The horizontal line.
yeah, this horizontal line up to here, and after that there is this horizontal line plus this line becomes this line. So
Yes.
this becomes our payoff
Mm.
when if st is greater than x. If st is less than x, then our horizontal line remains at zero. So it doesn't become negative. So if you buy a put and you buy the underlying, you will in forward you have to pay below the exercise price. Means you have negative value at maturity.
Yes, sir.
But if you have bought put and underlying, then you don't have any negative value at maturity, because the put is protecting you.
Yes, sir.
Yeah. So this one is the equation that you have to P0 plus S0 is equal to C0 plus PVX. If you remember, there will be one question definitely from this equation in the exam. Definitely. There's no doubt in that. 100% I can say there will be one question. So since there are 10 chapters in derivatives, and probably you will have seven or either 7 questions or 5 questions, whatever, you will have definitely. So, and there will be one question definitely from this equation. So, and it is easy to remember that P0 plus S0 is you buy a protective put is equal to fiduciary call. That's what. In English, if you want to remember, protective put is equal to fiduciary call. And this one was the equation of covered call. And covered call is equal to, this one is covered call. This part is called covered call. So let me write this. And this one is S0 minus P0 is covered call. So this is the equation of covered call, this part. Yeah. So this one is a covered call. So that is equal to, well, if you remember this equation, you can easily derive what covered call is. That present, you don't have to remember covered call counterpart. So long as you know the definition of covered call and P0 plus S0 put call parity, you can easily write the other part. Now, what it is telling, this one is for exercise. So protective put is S0 plus P0. So underlying asset is ST and put option when utilized, this becomes X minus ST. When this ST is below X, means put has been exercised, means this ST is below XT, so the person will get XT. The one who has got protective put, he is assured of getting XT at expiration. That is what he will get. That is the minimum that he will get. How much maximum will he get? That he will get is ST. Because if the price is higher, means when the put is not, this one is protective put. No, okay, yeah. So means ST is higher than X, then the put will not be exercised and he will get ST. So when exercised, he will get X, means when the price has fallen down, the protective put will give him X. And when it is not exercised, means they are at the money, then X and ST are equal. Because ST is equal to X, then no exercise, neither of call nor of put. And when put is not exercised, means ST is above X, so he will get ST. So that is the payoff, total payoff of protective put versus fiduciary call or put call parity. Okay, in the fiduciary call, the call option, when he buys call option, no. And what is the price of call? It is not written here, it is only about payoff. So when call is not exercised, means he will get what? The price of ST is below X. So he will also get X because he has this, he will exercise what it is. So risk-free asset. He has bought risk-free asset. It's not that he will exercise. So if call has not been exercised, the value of call is 0. And he had bought call plus risk-free asset. So that risk-free asset became X. So his portfolio is X. So that way, this X is equal to this X. We got put call parity. When no exercise, then also same, it remains the X because this ST and X are equal. And when call is exercised, means ST is greater than X. So he will get, what will he get? He will get ST minus X, the money from call, the one, this upward going part, and the display that he has already purchased. So this X and this X cancel, and he gets ST. So this ST and this ST are equal. So that is how this put call parity equation tells S0 plus P0 is equal to C0. Okay. Is it clear or was I too fast?
Clear, sir.
Clear. Very good. Now we are going to do it with numbers. So this equation is very easy. You all remember it. Now, who will read this? You will solve it. Okay, Yogesh, you read and then we will solve it.
In an earlier example, the VFO held non-dividend paying Biomain shares currently priced as 295 rupees per share. VFO is considering the purchase of a 6-month put on Biomain shares at an exercise price of 265. VFO's chief investment officer observes a traded 6-month call option price of 59. for the same 265 exercise price, what should we expect to pay for the put per share if the relevant risk-free rate is 4%?
Okay, so it is telling us to calculate the price of put, means P0. So we
P0.
have to find P0. Sorry, let me put it with blue. So we have to find this P0. Now we given S0. Do we know S0? What is S0? It is 295 per zero. Yeah. So we will simply put 295 plus P0 is equal to C0. So what is the call price? The call price is 59 here. Yeah. The 6-month call option price is 59. So we put 59 and then present value of exercise price. So our exercise price is X. So we took the present value of exercise price. So do you get this? Can you calculate on your calculator?
Yes, sir.
Okay, so try. If you get this, then fine. Then it is just a equation, very simple equation. So did you get 259.85? It is, you have to discount it for 6 months at the rate of 4%. The risk-free rate is what? Risk-free rate is 4%. Yeah, it is given there, yes. So once you get, you just confirm 259.85. So
Yes,
Aswath, you got it, no?
Yes, sir.
Yeah, so then it is P0 is 23.85. Very simple. So once you know the put call parity, you can solve at least 4 questions. They will ask you to to find the price of underlying, to find the exercise price also they may ask you, and they will give you these 3 information. So you have to find one of the information. When 3 will be given. Now, arbitrage opportunity. Okay, so Shashwat, you read this question and I will ask you what you will do. Okay, read this question.
As an example one, the Viswan family office holds non-dividend paying Biomian shares at price S0 of INR 295 per share. VFO is considering the purchase of a put for which it expects to pay INR 23.85, but which is instead currently priced at INR 30.
Okay, so we had calculated 38, 2385. We had calculated, yeah. So that
Uh,
should be the fair price of the put.
hmm.
But now in the market, this price is 30. Someone has calculated it wrongly. Okay, so then read further.
Assuming a risk-free rate of 4%, identify the arbitrage opportunity and the steps VFO might take to earn a riskless profit.
Okay, very good. So what you will do? So here is we have this equation. Yeah, we have this equation for parity, and instead of 2385, this one is 30. Means there is a arbitrage opportunity of 6 rupees 15 cents. So what will you do? Which one you will buy? And what do arbitragers do? I had explained. Yeah.
They'll sell the put.
You will sell the put. Very good. And then what will
bu-
you
bu-
buy?
Buy the call.
That's it.
bu- Buy
What
the
else
call.
will you do? Means if you sell the put, you buy the call, then how much is the call price? Call price is 59. Okay. So you sell the put and buy the call for 59. And what else? Okay. So this one is 30 and this one is 59. So equation will still not be equal. Yeah. And then you will buy, okay, your answer is about 75% correct. Well, if I go by this, then 50% is correct, not all. Okay. So you will sell the put and buy the put, buy the call. What else will you buy and what else will you sell?
One second, can I read the
Hmm?
questions? I'll read the question once more.
Okay. You don't have
Uh,
to read the question again. Okay.
what else we can?
You simply sell the entire thing, no? So you
Oh,
sell zero as
so,
well and buy the bond. That's it.
oh, so we'll share. We'll sell the put and the share.
Yeah, sell the put and share and buy both these. That's it.
Buy both call
Yeah,
and
maybe if you sold both, then you will
uh,
have to buy both as well. No?
both. Okay, okay.
This one is what? The risk-free bond. That's it.
A risk free. Okay, okay.
Yeah, this one is risk-free
Risk-free bond
bond. And what is the price today? Because it is already discounted by minus T, no? Here. So it is not this exercise price. Means you will buy a bond today whose face value is equal to X after 6 months.
Okay.
So since you sold both these, you will have to buy both these. That's what it is. That is what the arbitrage opportunity.
So
So
essentially, we are just buying the RHS which is at a lower price and selling it to the LHS which is at a higher
very
price.
good. Then only you will be able to make arbitrage profit. So he says, no, by selling the put and the shares, means by selling the put and the shares and purchasing the call and the risk-free asset at TGO, VFO has a positive cash flow of 650. Okay. So all these are just explanation. We have already done, so no point in discussing those lines. But if you want to tell me, I will discuss. But that is nothing more than that. Means sell the it shows that how sell the put and how sell the call will give you this much money. Then you invest it and then you buy the bond, and then you invest in buying the call and buying the bond today. Then at maturity it will grow to X and this call will be in the money or out of the money, whatever it happens. That is what it is explaining, that if in the money, if at the money, and if out of the money, it will have the same phrase. It means cash flow at zero, then put exercise means put is in the money, not call. Then no exercise and call. So it is just a repetition of what we did. So there is no point in discussing. It will not add to your knowledge, just wastage of time. Now, what is this? Option study based on put call parity. I think it will be very easy for you both, so long as you remember that. Mm, So we have this. What is the price of put? You already calculated C0 plus X present value of X minus S0. So that was you had already calculated 23.85. Now
They are
let's
just
go
rearranging the put call price.
rearranging the 4 times. That is what they will do. Let's see. Yeah, so S0 is equal to C0 minus P0. That is, you can solve all these four
So does it
questions.
have any name like productive call, fiduciary call, something like that?
Yeah.
Or?
So this one is the stock. This one is just price of the stock. Okay.
Oh, okay.
Yeah. And this entire fiduciary call is this plus this. C0 plus this is fiduciary call. So you have to remember that protective put is equal to fiduciary call. That's it in English. And protective put is S0 plus P0 means underlying plus put, and fiduciary call is present value of exercise price plus call price. That is fiduciary call means when we buy the call and we also buy the bond, then it becomes fiduciary call because it is giving some trust to the buyer of the call in the sense means it is, your call is supported by some money. So fiduciary call is present value of exercise price plus call. That is the fiduciary call. So it is just rearranging those things and in graph. Now let's solve this question. What is this short long? I have okay. Replication of individual position under put call parity. Same rearranging. Okay. So your turn, Yogi. You read this question and we will solve it. Okay. What does it tell? What am I disconnected?
No, sir. No, sir. You're here.
Oh, okay, yeah. I am not disconnected. Okay, yeah. So, Yogi, please read this question and then we will solve it. Is it a question? Recall that holds non. Since VFO chief engineer believes biomass share price will. Okay, yeah. Please read this. Then we will discuss it. Looks like Yogi's voice is not coming.
Sorry.
Yeah, please read this.
VFO covered call strategy. Recall from an earlier example, VFO holds non-dividend paying biomain shares currently at S not 295 per share. Since VFO's CAO believes biomain share price will appreciate over the long term but remain
Yeah.
relatively unchanged in the next 6 months, you would like to sell a 6-month call option at 325 exercise price to generate short-term income in what is known as covered call strategy. Using put call parity, how can he replicate his position using a risk-free bond if the risk-free rate is 4% and a put option? And what is the expected call option premium if the put option has a price of 56?
So he's telling that he wants to sell covered call. Okay. So covered call is not protective put. What was that? So let's do cover. Let me.
Covered call is PV of X minus P naught.
Covered call is what? S0
Present value of
means
X minus P naught.
sorry. Say once again.
Sir, the present value of X minus P naught.
No. Covered call is not that. Covered call is S0 minus C0. Covered call is
Oh, yes, sir, the other side. Oh, yes,
yes,
S0
S0 minus C0 means you buy the underlying means your call is fully covered.
yes,
So if call goes up, your S0 also goes up. So that way you are fully solvent. In fiduciary call, you are not fully solvent. You are solvent only up to exercise price. But in covered call, you are fully solvent. So S0 minus C0 is covered call. And fiduciary call is equal to C0 plus present value of X. That is what fiduciary call is.
sir, can you repeat the part which you said like fully covered?
Fully covered call means whatever there is unlimited loss to the seller of the call because the market price can go up to unlimited. Yeah.
Yes,
So if you have the stock, so even if the call goes say from 30 rupees to 500, your stock will also go up, from 295 to another 300, so 695. So that your call is fully covered. That is what this covered call is. Means the call, there is a one-to-one relationship, no at maturity. Means if call price goes up, stock price also goes up by 1. Or rather it is stock price goes up by 1, then call price also goes up by 1. So if the call price increases, it means your stock price is also increasing. So that way this is called covered call.
yes, sir. But
Yeah.
for fiduciary call, it is covered until
Only exercise price. Because this price will go only up to what? Up to present value only up to X. Means at maturity, since it is a bond, you will receive only X. So, but in this case, you haven't sold the call, you have bought the call. So you are thinking that, well, I will have minimum present value of X, and if the market goes up, then I will have unlimited gain. Means by the time, by the amount, the market goes up above X. So fiduciary call is somewhat like if market goes up, you benefit. If your market doesn't go up, you are guaranteed this X. Means here you are owner of both. In protective put also you are owner of both. So in protective put is equal to S0 plus P0. So In protective put, you own both these things. So protective put is equal to fiduciary call. Covered call is S0 minus C0. It is different from these two. So, is it clear?
Yes, sir.
Okay, so let's see the discussion. What does it tell? So it is telling that since this CIO expects that the price will go up, means S will go up. So what he is thinking, he is selling the C0. In the long term, S will go up, but not in the short run, but remain relatively unchanged for the next 6 months. So that's why he is selling C0, so that he will get some money. His stock, he can sell a naked call because he already has this S0 as collateral. So in the market, he can sell call naked call because it is covered. So
What is the definition of the naked call, sir?
naked call means C0, that's it. Means
Oh.
without security.
Okay.
Naked call means without security. It is without cover. Okay. So he can sell the call. Otherwise, what will happen? The exchange will ask you to deposit money. And yeah, before selling the call. So you cannot sell the call unless you have the stock. So he can sell the call. So he is expecting that in the next 6 months, the market will not go up. So whatever he sells the call, the money he will put in his pocket because that call will expire moneyless. Okay. He would like to sell a 6-month call option at Indian rupees 325 exercise price, means X is 325. Okay. Now, and so he is telling us that using put call parity, how can he replicate this position? Yeah. So we will, since we know the definition, let's substitute C0 with these. So how will he replicate? Let's cover this. So S0 means he wants to replicate covered call. Yeah. So S0 minus C0 is the covered call and C0 is equal to what? Put call parity. Let me put it a bit down. So if I calculate C0, so C0 is equal to what? Let me put it here. C0 is equal to what? If it is C0 is equal to this, so I am putting only C0. So if I bring this PVX here, means if I put minus PVX, I get C0. So C0 is equal to S0 plus P0 minus PVX. That's correct? This C0?
Yes,
No,
sir.
no, no.
Sir.
Now, I have to change covered call. So covered call is S0 minus C0. So S0 minus, if I put what? Minus S0. Yeah. And then minus P0. And then plus PVX. I get the answer. So this S0 is cancelled. Both, so well, why should I delete? So this one is equal to what? So what answer do I get? I get the answer that buy bond, buy risk-free bond. So answer is buy risk-free bond and sell put. That will give the answer of this question because it says using put call parity, how can he replicate this position using a risk-free bond? Means buy the risk-free bond and sell the put. That is what we get the answer.
Yes,
This is clear?
yes, sir, clear.
Okay, so let's see what is the answer. Mm, yeah, so here it is. The answer is here itself. So the covered call position is therefore equivalent to a long risk-free bond and a short put position. Yes, that is what we got, long risk-free bond and a short put position. Now, what is it? We may solve for no arbitrage call price. Okay, that is not difficult at all. So is it asking us to calculate? It is not asking us. Okay. So let's answer this question. And so Shashwat will start this question number
Sir, he's
1.
not there in the call.
Oh, he's not in the call? Okay. So you can, what happened? He got disconnected?
Yes, sir.
Okay, okay. So probably he will join back this internet connection or electricity connection. So okay. So you can join, you can start this. Okay, read this.
Determine the correct answers to complete the following. If two portfolios have cash flows that are dash at time t under each scenario, then the no arbitrage prices of these portfolios must dash one another at t is equal to 0 in a relationship commonly referred to as have
What
cash
called
flows
parity? Okay, so what is telling? If two portfolios have cash flows that are
similar,
equal,
equal, similar.
yeah, equal or equivalent at time t under each scenario, then the no arbitrage price of those portfolios must equal or
Equal.
match one another at t0 in a relationship commonly referred to as put call parity. So either it should be match, equal, let's see. What is this? If are
Similar.
identical, yeah, equal or identical, and must equal. So that's fine. We were correct. Okay, oh, you have to match this. Yeah, this one should be easy.
Identify which of the following position has the same no arbitrage value as which portfolio under put call parity.
Let me bring this
So
formula.
rearrange the
So you
formula.
can easily do it. I think I can bring this. Can I copy this? No?
Yes, sir.
Yeah, if I can copy this and paste.
Just control A, control C, sir.
Oh, okay. Control A, yeah, and control V, no?
Control C, sir.
Control
First,
C.
first copy and then paste.
Oh, okay. So control C and control V. What happened? Could I post or no? Oh, yeah, control C is control. Okay, let me
Sir,
see.
it pasted there itself.
Oh, here itself?
Yes, sir. You can drag it now.
Oh, okay, okay, I can drag it down. Then you won't make any mistake. Otherwise, if you calculate, okay, so control X, control A, first control A, then control X. And I paste it here. Control V. Now it is correct. Okay. So, see this. So here is, there is no need of covered call. I should delete this. This may confuse you. And I will put this also here and equal to here. And let me delete this part. So there is no confusion now. Now you can answer easily.
Yes, sir. So short call option would be longing the bond minus S naught minus P naught.
Yeah, minus PVX. So long the bond, long the put, minus PVX. What is it? Is short call? No,
No,
sorry.
sir, it's the
Sorry.
opposite, sir. So it is
Opposite. Yeah, so
PV
this
of
will be
X minus S naught minus P naught.
very good. Short underline, short put B. Yeah,
Yes, sir. Long
B.
the risk
B
free
matches
bond.
this, no?
Yes, yes, sir. B.
Okay. Now,
Long risk free bond is S0 plus P0 minus C0. So which
yeah,
is minus short the call option, long the underlying and long the put. Yes, sir. So option C, sir.
C. Okay. And what about 3?
Long put is C0 plus
Oh,
P0.
well, definitely will be A, but anyway. But anyway, read it so that
So short the
long put option P0 means
short the
this one.
underlying and long the other two. Long call
Short
and
the
long risk.
underlying, long risk, free bond, and long call option. Yeah, so A, correct?
Yes, sir.
So B, C, A. B, C, A. Okay. Now this question. Yeah.
Determine the correct answer to complete the following sentence. The combination of a dash call and a risk-free bond position is known as fiduciary call. Long call.
Yeah, long call and a risk bond. Very good. You remember it. Means I shouldn't have deleted. That was used in this question. Yes. A purchase call, long call. Okay, question 4.
Identify the following as true or false and justify your answer. The covered call strategy consists of a long position and the underlying in the underlying and a long call option at inception. No,
Okay,
sir,
so
that
let's
is
bring
S
that.
naught minus C naught.
Yeah. Let me bring that. What had we found? Oh, we had brought it here. No, this one was our. So control A, control C, and I will paste it. This question, no?
Yes, sir.
Control V. So what does it tell?
Sir, covered call should be S naught minus C naught, not S naught plus C naught.
Yeah. So it's not minus is false.
False.
The statement is false. Yeah, the S0 minus C0 at inception, that is covered false. Okay. So put call forward parity. This one is, put call parity. And what do you know about forward? So what is the formula of F0T is equal to what? You remember?
Sir, S
S
naught into 1 plus R power T.
into 1 plus R to the power T. So 1 plus R to the power T. Yeah. So what is put called parity? Let me bring that copy and paste so that we can do it very
Oh,
easily.
we are just rearranging S naught in terms of the put call parity again.
No, put call parity. Yeah, no, we will arrange in that only.
Oh, okay.
Yeah, we will arrange in that only. That's why I'm trying to copy it. But we are converting this into, where was that? Where did I write that? When did I write? Oh, probably I went down. Where had I written? I was just trying to. Oh, okay. So this one. No. Oh, did I cut it? Okay. Let me have this. No worries. Let me copy only this. Control A, then Control C, and Control V here. Put call parity into forward. Yeah. So I am putting this here. Control V. Okay. So it is telling us put call forward parity. So where is forward here? It is there is no forward here. So we know that F02 is that. Or if we just convert it into F0T times 1 plus R to the power minus T. Yeah, minus T. This one is equal to S0. Yeah, we got this. So input call parity, we have this S0. So what I am doing is that I am simply copying this, Control C, and bring it here. So let me paste this here. Control V. Oh, Control C.
You have to click and
Oh, yeah, I
then
have to
press
first
on.
click. Yeah, and then Control V. Yeah, this one is here.
Yes, sir.
Okay. So this one is my S0, and plus P0 is equal to C0 plus PVX. Yeah, plus PVX, and that is your put call. Yeah, this is your forward put call parity. That's it. Means you brought forward and you made it parity. So now this one has become what?
So parity means just writing it in an equation, right?
Yeah, writing the
Oh,
equation equal
yes, sir.
to,
Oh, yes.
yeah, both are equal. That is what it is. So this becomes your put call forward parity. F0T times 1 plus R to the minus T plus P0 is equal to C0 plus X times 1 plus R to the power minus T, which is PVX. Yeah. So nothing great, very easy. Now, what is called synthetic put? So now the first portfolio has replaced the cash underlying position with a synthetic underlying position, using a forward purchase and a risk-free bond. So forward purchase is zero, no? At the time of purchase, this forward price is zero. But what is this? This is not forward price. This one is a risk-free bond because the forward price discounted today is some risk-free bond, and that risk-free bond has a price now. So the forward price is zero because we have symmetry. So otherwise, F0T is not zero. It has some value like X in our case. So we have this present value of X plus P0. Now, what has happened? This is called synthetic protective put because this is not underlying but F0T. So if you are buying F0T, you don't have to pay any money right now. Yeah. But then you have to buy the bond. And that bond is called synthetic underlying position using a forward purchase and a risk-free bond. So what you are doing that this bond plus forward purchase is zero. So if I write 0 plus this, there is no change in the value. Yeah. And this entire thing means which is F0T. 0 is F0T. Or let me write it. What should I write? 0 and in within bracket. So F0 and sorry, F0 and this T is equal to 0 plus this risk-free bond. So what is he doing? He is doing. He is buying a forward and the risk-free bond. Then put this becomes equal to call plus present value of exercise price. That is what it is telling. So that's how we have this synthetic protective put. This part is synthetic. There is no underlying. So we had discussed that in the forward. Probably you might have forgotten by now that we can replicate forward by buying a risk-free bond. We can replicate this S0 by buying a forward and a risk-free bond. That is what we had studied. Means we had studied that S0 because S0 is equal to F0T plus risk-free asset plus risk-free asset. That is what we had studied when we were replicating our stock with forward purchase. Means we buy forward and we buy a risk-free bond that is equal to our S0. So F0T plus this risk-free bond, this becomes our synthetic S0. So this part is called, this entire part from here to here. Yeah, this one is called synthetic. I think this part F0 plus this one is called synthetic stock because it is not a stock, it is just synthetic stock. Synthetic stock means forward whose value is 0 right now and plus buying the bond, risk-free bond. So this one is called.
So then the F0T into 1 plus R to the power minus T and PV of X, will they not get cancelled out?
If they are equal, then they will get cancelled out. If F0T, this one is also PV of, if this one is equal to, if F0T is equal to X, then yes, this will cancel out.
So then that will be P naught is equal to C naught, right?
No, P naught plus F02 will be C naught. That is the trick here. Means today, even though its price is 0, but you have to sign the agreement. That is the finance behind it. So even though you don't pay anything for forward right now, but you just sign the agreement. So sign the agreement, then plus P0, that becomes a C0.
So then, mathematically, PV of x and F0t of 1 plus r to the power minus c, they should get cancelled, right? So
Yes, if F0t is x, yeah. So they got cancelled, but still you have to have this no F0t. F0t plus P0 is equal to C0. Yeah, you're correct.
the F0t is nothing but the exercise price, right?
No, F0t is nothing but the exercise
Exercise
price.
price.
No, yeah, when? At the time of maturity, no?
Yes, sir. At the time of
Yeah,
maturity, it's the
but,
exercise
but,
price.
but it is not certain. I mean, okay, yeah. Even though you sign F0T, but you can have loss and gain, no? Because whenever you buy a forward, even though its price is 0 today, but at maturity, if the ST is more, then F0T is actually ST minus X. F0T is ST minus X.
So that is the gain on the F0t, right? But
Yeah, that is
F0t is just
yeah,
nothing
no,
but the X.
but it can be less as well, no? Means you put F0T at X, but you are not guaranteed that you will receive X that day. If the ST goes up or down, then you may incur even loss if it is below X. So that's why this P0 and C0 won't be equal. C0 is equal to P0 plus F0T. That is what it is. Even when you have this exercise price of call and put equal, still, so C0 will be higher than P0. When same expiry, same exercise price, C0 will be higher than call, and this present value of FST minus F0T will be somewhat some money.
Sir.
So that's what put call parity is. Though today, if you do today, then yes, P0 should be C0. But then you are not sure know that F02 will be X because on expiry, ST can be different from F02.
Yes, sir, but like the ST minus X and X minus ST, that depends on the gain or loss, but F0T has to be X, right? By
Yes,
design.
F0T has to be X.
Uh,
But then what? You are not, you will not have any loss that day.
Sir, but
F0T,
here we don't talk about the gain or loss, right? We're just comparing the price of the forward with the call option price and the put option price and the risk-free bond. So mathematically, it should be P naught is equal to C naught.
no, mathematically, yeah. Mathematically, today it looks like that, but actually C0 is equal to P0 plus F0T. And the price of F0T is 0 today. So today P0 should be equal to C0. But then there will be arbitrage. Because
Then that would mean a present value of X is 0 or what is the present value of the risk-free bond?
both X are equal. No, I'm saying that, yeah, X is equal for both. F0T is X. So in that case, this and this will cancel.
Cancel out. Yes, sir.
But still P0 and C0 mathematically today they should be the same price because F0T is 0. But in
yes.
the market they will not be the same price.
Yes, sir. It will be different.
It
Only
will
then
be
the trade will happen.
Yes. So F0T plus P0 is equal to C0. That is what linking the forward with put call parity happens.
Yes, sir.
Okay, so let's go down. And that's how it is showing the same thing that how when in under three conditions both ST will be equal, X will be equal, and this P0 plus S0 and P0 plus S0 will be equal. So nothing. Compare the future cash flow. So in future cash flow also, well, this X and this X is equal. It is just showing, okay, let me see. So yeah, now it is rearranging. P0 minus C0 is equal to X minus F0T times 1 plus R to the minus power minus. What is this? If we rearrange these terms that we had written here. So we had written this here. So I buy it, control A, well, control C, and then I buy here, I put here control V. This one is the same. Mm, Control V. Let me delete this part. This one is not needed. Hmm. So, what is this? Oh, okay. If I put it here, then it is the best. So, this one is saying that P0 minus C0. This brought here. P0 minus C0 is equal to X. Oh, I had written present value of X. Where did that go? Okay, okay. Probably PVX. This one is PV. That's I deleted by mistake. So let me put it here a bit down. Then this okay, yeah, here. So this equation and this equation is the same. Means P0 minus C0. We brought it, and then we brought this F0T here. So PVX is the same as this
Yes,
X.
sir, they take the common of 1 plus r to the power minus.
Yeah.
Oh.
So nothing.
Yes.
Same thing. Same equation. Now, okay. It is telling us to calculate the price. No need to calculate. You already have done this many times, present value. So, put call parity. Okay. Now,
Oh, sir, can we just read that question, sir? Once,
okay. Yeah, please read it. You will find it very easy. Yeah, read it.
Consider the VFO example using a long forward and risk-free bond rather than a cash underlying position at the prior example. Bioman shares traded at S0 295. VFO is considering purchase of 6 months put option at an exercise price of 265. If VFO CFO brings a traded 6-month call option of 59 and 265 exercise price, what should be expected to be the put option? The relevant risk-free rate is 4%. Sir, okay, so C naught is given, X is given. Oh, okay, so there is a difference between X and F0 of T.
There is a difference between X and
If not, yes, sir.
F not T. Well, it is not actually this F0T can be X also. Is it telling?
Yes, sir.
Using a long forward and discrete bond rather than a cash underlying position. So Bioman shares trade at okay 295. So this 295 will be F02. Since it is 295 today, so F02 will be 300 something, 300.84. That is what we knew. Yeah, 300.84. Yes. So here it is different. Yes. So F02T is different here. But you can have it at X as well. So if you have it at X, then P0 will be C0 today. So that I agree, because mathematically in the market, how will they show that F0 is F0T is 0, so it is 0. So, but well, there are transaction costs as well. So market price and market in the market P0 and C0 will differ slightly. Okay, so yeah, here they are.
Yes, sir. So understood the question.
You understood the question. Now, do you want to read it further?
It is just solving, sir.
Just solving. So now you can do it easily, yeah?
Yes, sir.
Nothing. Okay. Now, how to value the firm? Did he come back or not? Shashwat. Okay, that's very sad. Well, he will watch the video then. What else we can do? So the insights established. Assume that okay. So put call parity. We have done this very well. We linked it with forward as well. Forward put call parity. Now, how this equation, the firm, the value of the firm is equal to equity of the firm plus debt. And if I am trying to calculate what is the value of debt, then I must calculate the present value of debt today. So today the price of equity is there, and then the debt is payable after some years or some months. So if I want to calculate the total value of the company or firm, then it is the value of equity plus present value of the debt. Yeah.
So why are we adding the debt, sir? Should it not be subtracted?
No. You have to add, no? Because you know why this debt is valuable? What is the value? Oh, in accounting, we subtract what? Equity and debt. No, means, well, liabilities plus stockholders' equity is equal to total assets.
Yes, sir. Yes, sir.
So total assets is the present value of the firm. So liability is what? Is their debt. So present value of debt plus equity is equal to total assets, and total assets is the value of the firm. So from
Okay.
account, yeah,
Okay.
you got it? From
Okay,
account,
just writing that only. Okay.
yeah. Because the value of the firm is total assets.
Okay. Okay.
Yeah. Now, when the total assets are greater than D, then the firm is solvent. It will pay. So whatever is the value of the firm, if we deduct from that the debt, present value of debt, we get equity. Yeah.
Sir, but
So,
according to like our accounting, then both should be equal, no, sir? Like they balance out anyway. So they
in,
balance out.
in accounting, we have total assets is equal to total liability plus equity. That is what we have.
Yes, sir.
So total assets is the value. This one is V0, value of the firm. This one is V. Yeah, VT at time T. Yeah. This one is VT. And total liability will also be T some at some time. And equity will also be at some time T. So at one time, this identity must prevail. Yeah.
Yes, sir.
So that way, ET is equal to VT minus D. Yeah. VT minus, and this one is what? This one is D. This one is our, let me go down. So V I already wrote, and this one is D, sorry, D, and ET is E, so D plus E T. If I'm writing T, then I will have to write DT as well. So DT. So DT for VT is equal to that's what is. So that is what we is writing. So ET is equal to VT minus D. Okay, he's writing just D. If he's writing ET, then he should write DT as well. Okay. Anyway, so under insolvency, VT is less than D. So what does it mean? So it means that debt holders have a priority claim and assets because equity will be zero. So the minimum value of equity is zero. It won't go below zero. So we had discussed that it is protected by a put because if we have a forward and buy a put, then we were protected from a fall. So since E cannot be less than zero, it cannot be less than, E cannot be negative, means the stockholders have bought a put whose exercise price is zero. That we can say. So, yeah.
So either they receive the positive dividends or they don't receive anything, but not negative.
Yeah, they don't have to pay.
Yes.
Means if the company, if the value of the company is less than the total debt, the stockholders don't have to pay anything. They just their equity is zero. That's it. Yeah? That is what this accounting principle is. So, what has happened to the debt holders? They haven't. Their debt is not risk free. Means whatever they have lent, they may not receive it if the company closes in a bad situation and its scrap value is less than D, they may not receive the D. So in that case, they need to be compensated. So how will they be compensated? They will sell something. Now, what will they sell? What can they sell coal? And the answer is no, because their end value, exercise value X is fixed. They cannot get more than what they can get as total debt. So whatever they have lent, they can get only the risk-free rate or whatever interest rate. So means today's loan times 1 plus interest to the power t. That is what maximum they can get. So call has unlimited potential. So it means they have not sold the call. The debt owners haven't sold the call. So what can they sell? Then only put is left. So they will sell the put. That okay? Put premium, they will put in the pocket today. And then they will lend. So whatever they have lent, so basically in the eyes of company, they have given a loan, and in order to cover some credit risk, that it is not a risk-free loan, it is risky loan. So in order to cover that risk, they sold the put to the stockholders. And what did the stockholders buy? They bought a call, because call on the firm's asset means if the underlying goes above X, then they will have one-to-one relationship. Otherwise, they will get a zero. Yeah. So that's how it is going on.
Sir, how will it show in the like in the balance sheets? Like,
Oh, in the balance sheet, they cannot show this. This one is a research topic, that how to value a firm. That is just an one is Tobin's Q model. That Q is value of the firm is total debt plus total equity. And if the market value is more than that, means Tobin's Q is replacement price divided by that total debt. So if it is more than 1, then the companies are equating. So one valuation is Tobin's Q. Another valuation is dividend discount model. Then you value by discounting free cash flow to the firm. So these are the different methods of valuing a firm. So this is an alternative model that tells that how to value a firm. But it will not give you, it will tell you to calculate the price of the call and then price of the put and debt, and that way they will calculate it. But nobody uses this method for valuing a firm. It is just more an academic exercise. The most widely used method is discounted value of free cash flow to the firm. Means even if the firm has not given dividend, it has retained itself, then it adds to the value of the firm. Otherwise, old model was dividend discount model. Means whatever dividend was received, the investors discounted, and that should be the price of the equity. But here, because the dividend is the return of the equity, but many firms don't give dividend. So how to value them? So to value them, we use the free cash flow to the firm, okay, and discount it.
will we study this in the portfolio management?
You will study this in this model, I think, in equity valuation. Yes,
Oh, okay.
definitely. So if it is not in level 1, then it is definitely in level 2, because I had studied in level 2, but you will have some information here as well. Okay, so this one is showing again profit and loss, that how this payoff shows. So this payoff is like the payoff a call option. Yes, means
Yes,
beyond exercise price. So that is what this is the shareholders payoff. Means shareholders have purchased a put option so that they don't go below D, total debt. So they don't have to pay any money. So when they buy a put option whose exercise price is D, means total debt, then if the stock market goes below that, then they are protected by the purchase of that put. So the shareholders have purchased a put from the bond holders, and what they have long term assets. Means
sir, can we take a 5-minute break, sir? I just want to get a courier from outside.
okay,
That's
yes,
the person
sure,
at the door.
go. And but
Yes.
then 5 minutes or 1 minute.
He's stuck in the road, sir. So like I have to tell him the
Oh,
direction. Yes, sir.
you have to go there
I'll
because
come
there
as soon
will
as
be.
possible, sir.
Okay, okay, okay.
Yes.
Go ahead, and I am having a break, so I will have to stop the video or what?
No, sir. No, sir. You can just leave it like this.
Leave it like okay. Go ahead.
Yes, sir.
Yeah, sure. Go.
Sir,
Okay. Okay. So you are back?
yes, sir, back, sir. Yes, sir.
Okay, very good. So we can discuss this. We were here on this page that the exercise price for shareholders of put was, and for call as well, the total value of the debt of the firm.
Yes,
So
sir.
there is, since they have this uh, shareholders are long firm assets. So what happens? They purchased put, and so it went down, and it started from here because below debt, below the total debt, they don't have to pay anything. The firm is still valuable. So this becomes their exercise price, and so this becomes horizontal. The payoff line becomes horizontal, and if the value of firm VT is greater than D, then it is again one-to-one relationship. So the shareholders get payoff. So this is nothing but looks like the payoff of a call. Yeah, you are familiar with this picture.
Yes, sir.
Now, yeah. So for shareholders, they sold put. Now, if they sell the put, then below exercise price, if the price falls down, the seller starts exercising loss, and the loss is here like this. So for put, they received this. They also bought long free debt. Means long risk free debt means, of course, they lent it. So they lent it someone risk free rate, but then for additional credit risk, they sold the put. So they got put money today and put it in their pocket. So when combined that, uh, this becomes their payoff. Now, this D is above this D because this difference is the price of the put that they have received. Or you can say here that this is the price of the put that they have received. This is the P0 that they sold. Yeah, P0. This is the price of the put that they pocketed, and so above risk-free rate. So this is P0, and that's why this one is starting from not from zero, but above zero it is ending. And here this is the exercise price. So if the price of the company is more than exercise price, they are not getting anything extra. So all they can get is maximum is D at the maturity. So that's why it remains fixed, even, and whatever the gain is there, that is taken away by shareholders. So this one is looking like buying a risk-free debt and selling a put. So because the put price is only this much, so that's what is starting above, and this difference is buying the risk-free debt. So what did we
Yes, sir.
learn? That this call put parity model tells us that the stockholders have bought a call on the assets of the firm beyond the value of debt. Because so this call is beyond the value. Well, they have bought a call, simple, on firm's asset, because until D they will not get anything. So the call also doesn't get anything until exercise price. So the shareholders have bought a call option on the assets of the firm, and they also bought a put from the debt holders. So they bought two things: long firm assets and purchased a put from the debt givers. And
Sir,
yeah.
so the primary interest of the debt holders would be the downfall of the company, right?
No. If there is downfall, then what those guys will get? They will get less than D, no? So they don't want that it should be downfall. Because if the value of a company falls below this, then they start losing, no? The debt holders.
Oh, okay. They start losing their sir. Okay, okay,
Yeah.
okay.
So they also don't want that the firm should be bankrupt.
Okay.
Yeah. Both have their vested interest. So what is the profit to the shareholders? Well, beyond this point and above this point, all is shareholders pay off. And below this point, they are getting this profit. When the price is ST, means we here. So, well, they can get only their total debt. They are getting, this is the area of their total debt. If the price goes below, then their debt area, in fact, this is the total area of their debt. But if the price is above this, they are going to get their entire debt. So that's how the share of profits or the total assets are distributed between the total payoff is distributed between debt holders and equity holders. So I had already written this equation that V0 is equal to C. Now, revisiting the put call parity, S0 plus P0. Who are these? These are the equity holders. Means S0 plus P0 is the equity holders, and C0 is not actually, C0 is by equity holder. Let's see. Let me read it, what it tells. So from equation 1, we may substitute the value of the firm at time 0 V0 for the underlying assets S0 and substitute the debt for the risk-free bond X. So X is the exercise price here. So present value of debt, and then plus C0. Why the C0? And solve for V0 as follows. So it is just substituting this equation. So what will be the V0? So V0 is equal to C0, which they are buying, and then present value of debt minus P0. That is the total value of the company. What equities are buying? Equities are buying only C0. Yeah, this is what equities are buying, and the remaining part is bought by debt holders. So So this part, present value of debt minus P0 is the risk-free debt. This becomes because they have already purchased, sold P0 to cover the risk. So this becomes risk-free debt, which is our present value of X. No, this one is risk-free. So this part, this total is our risk-free debt. This total present value of D is risk, having some risk, some default risk. But when they sold put, they got some money, and that way it becomes this. This becomes our risk-free debt. Risk-free debt. This part here. So that's what I draw this. This is our risk-free debt. Okay. So this is our risk-free debt. Or well, I should have written like this as well. So this is risk-free debt. So what do we go to? So this P0 is the credit risk, may be interpreted as the credit spread on the firm's debt, because risk-free debt gives you the interest of just 2%, 2 to 3%. That's it, and this includes inflation. So the risk-free debt, when there is little inflation, it is just means in real terms, risk-free debt gives around 1 to 2% as a return, and add that to inflation. So that will become the risk-free debt. And above that, that becomes the credit risk. So credit risk, liquidity risk, both the things. So credit spread on the firm's debt or the premium above the risk-free rate the firm must pay to debt holders to assume insolvency risk. Now, this put option increases in value to shareholders as the likelihood of insolvency increases. What happens? That who gains? When the likelihood of insolvency means when the company is doing bad, the put premium increases for shareholders. Why?
That means we would come down, sir.
Huh?
That means we would come down.
Yeah, we would come down definitely. We would come down means this must go up because this cannot go down. And C they have already purchased. So, well, C will also go down. So this put option increases in value to shareholders as likelihood of insolvency increases. From the debt holder's perspective, the more valuable the sold put, the more credit risk is present in the firm's debt. Means when more valuable in the put risk means the credit risk is higher. So instead of buying discounted bonds at IRR of 5%, if they are getting 10% IRR on the bonds, it means the firm is more likely to be closed because this put is more valuable, the more credit risk is present in the firm's debt. So that is what debt holders feel.
Sir, but what if there is some additional capital that's infused suddenly by someone?
Means if they borrow more money, means they will not pay back. Means more debt increases the risk of the company to pay back. So in that case, the P0 will go up.
Oh,
PT will go up. Yes.
Sir, then there is no possibility of the company to recover.
No, there is possibility of recover. Means if they have good project, look, if they are borrowing without any project, then yes.
Oh, okay. Sir.
Yeah, but if they have good project in mind, and for that they are borrowing, then the company will do good.
Okay.
Means the credit rating will go up. But if it is using that money to pay salaries, to pay dividends, and to pay the cost of raw material or storage, which are expenses, then the company has become more risky and this P0 will go up. Okay, let's see. So that's all about our firm thing. So, okay, let's solve this question and then we will solve the beginning question.
Yes.
Okay, yeah.
Identify the following as true or false.
Just a minute, you have to identify, no? Just a minute. I think I will have to write that question again. Yeah. Okay.
The key link between put call parity and put call forward parity is that the cash underlying position is replaced by a synthetic underlying position using a forward purchase and a risk-free bond.
So it is true.
True,
Yeah?
yes.
One more thing. Okay. Okay. Should I write that equation? Then you will
Yes,
not
sir.
make mistake. Otherwise, you can make mistake. So I'm simply typing S0 plus P P0 is equal to small c C0 plus present value of x. Yeah, exercise price. This is put call price. Okay, now
Long call option. That would be
C0.
P0.
It has written
Sir,
here.
that will be C0, sir.
Yeah.
So S naught plus P naught minus PV of X. That would be forward of sale.
Okay,
Then
so let me write it here. This one is F0T.
F0. Yes.
F0T and this one is F0T times 1 plus R to the power minus T to the power minus T. Yeah, that is what is 1 plus R to the power. What is it? 1 plus.
So first one is B, sir.
Okay. What exactly? Yeah. 1 plus R to the minus T. Okay, so first one is B. Okay. B. B.
A long risk-free bond is
Forward purchase, yeah. Forward
call.
purchase plus long put and minus, yeah, correct.
C, sir. Second one is C, sir.
Second one is see, long risk-free bond means this one, PVX. So PVX long forward purchase plus short call and plus long put. Yeah, correct. Very good. Easy. So
Long put is
yeah.
minus this. Long put
P0.
option P0. So
Yeah,
why is it forward sale?
yeah. Forward sale will come this side, no?
So short forward is forward sale. Okay, sir. So
Yeah.
yeah. A.
Yes. So A is there, yes. BCA. Okay, yeah. Add it, So what is the cash flow? Describe the cash flow at the time of option expiration. It is the time of expiration for a synthetic protective put. So protective put is this one. So this becomes F0T, means at maturity, this will gone. This will be gone. So when, okay, so let me copy this. Control C, Control A, Control C, and here I will again press Control V, and this one will be gone at P. So at P, at P, we have this equation. So what will be the cash flow? Describe the cash flow at the time of option expiration for a synthetic protective put. So he is already long. Okay, so he's already long. Okay, okay. Synthetic long risk-free bond. So he is here long risk-free bond because it is protected put and long C0 as well. So at the time of option expiration T, there are two possible scenarios. Put option exercise. Okay. So it is telling us to whether if it is exercised or not. So if exercised means the price is less than the exercise value. So if the put option is exercised, an investor receives X minus ST, okay, and the risk-free return F0T. This also he received. So P0 is what? X minus ST. And then he will receive this. And when it is not exercised, then if put is unexercised, it will it expires the risk free, he will get only F0T. That is what it is telling. So if exercised and not exercised. So if not exercised, he will get only F0T. And if exercised, then he will get F0T plus X minus ST. So that is what it is. Okay. And question number 4.
Describe how a debt holder's position may be considered similar to the sale of a put option on firm value.
No need to describe. Okay, now let's go on the top one, which I had left, because you can write it. Okay. Put call parity. We were not solving this. I had left in the beginning, no? Okay, so we will answer these 4. Okay, question number 1.
Which of the following statements correctly describe the equivalent to a long position in an underlying according to put call parity?
So again, I write the question.
Equation.
Yes, then you can easily answer.
Should be shorting the puts. The other thing, shorting the put and others are long.
Shorting the put option on the underlying, long call option on the underlying, and long RSP bond. Okay, very good. So it describes the equivalent to long position of the put call parity. Equivalent to a long position in the underlying, yeah, S0. So it is asking for S0, yeah. Okay. Now, yeah, we will match this. Let's see whether you can match without writing that equation. Long, oh, you have done it right now. Anyway, do it.
Yes, sir. So long call would be starting the risk-free bond. So
yeah, so sorting the risk-free bond. Yes, very good. And long P and long S. So long underlying, yes. No, it is short underlying. Short underlying. Short underlying is here only. Plus long call option and short put option. What is this? Which of the following has the no arbitrage value put call parity? Okay, let me write it here so that we can do it.
S naught plus P naught is equal to C naught plus X into 1 plus R2.
Yeah. Yes.
So then this option is wrong, sir.
Option is wrong. Yeah, that is what I am feeling. PVX. So this is our equation. So long C. Yeah, let's see. Long C will be S0 long, P0 long, and minus short. So long underlying correct. Then long put correct and short. Yeah, B is correct answer.
Oh, okay.
Yeah, B is correct answer. Yes.
A short risk-free bond is minus PV of X, which is
means it will come
C naught minus S naught minus P naught. So A,
very
sir.
good.
A.
Good. A, very good. A, okay. And then
Sir, no, sir.
What?
That would be
short. Okay. Short put means bring this that is C naught minus S naught and minus P naught. So you are saying long underlying, no, short.
You can't short risk again. So that is wrong.
Short underlying.
C. It is C.
Yeah, short underlying means S minus S minus P. Long call option, yes. C naught minus S naught minus P naught. And sort of C. Yeah. It was a, yes, correct. C. Yes. And then short put option means bring put this side. So long S0, short C0, short PVX. So long underlying, short risk-free bond. Yeah, so yeah, correct.
Yes.
So this one is okay.
Yes, sir.
So we got this. B, C, A. Okay. Now question number 3. Let's see. Okay, sorry. Yeah.
Which of the following correctly describes synthetic protective put according to put call forward parity? long forward on the underlying, long put in the underlying, and short risk one.
Yeah, and that is the only correct answer.
Yes, sir. Yes, sir. Yes, sir.
A is the correct answer. Very
Yes, sir.
simple. I don't even need to bring, otherwise I'm going to bring that equation and substituting S with F0T. Okay. Which of the following? Yeah.
Describes a shareholder's claim in terms of a option payoff. Shareholder payoff resembles the payoff of put option on firm value. Covered call option on call option. Sorry, just saw it.
C,
I
no?
just saw it, sir.
Yeah.
See, sir. See, sir. See,
C,
sir.
yeah, it is C.
See.
Okay. Now we go to the final questions that in the chapter. So we already finished. Okay. Yes.
CSI has a Chinese equity portfolio that has outperformed in the first half of the year due to an overweight position in healthcare industry shares. It is considering option-based alternatives for one of its current overweight positions, CWI. CWI has a current price of Chinese yen 127.5 and pays no dividends. The current risk-free rate is 4%. You are a new analyst. I have to evaluate several alternatives to CWI stock. It is considering the sale of a 3-month call on CWI share. If you observe a traded put price with the same underlying details, which of the following statements describes how to arrive at a no arbitrage call price? Yes, sir. So, using put call parity, the call price may be derived by subtracting the traded put price, subtracting the traded put price from the underlying price. No, that should be added. Using put call parity, the call price may be derived by adding the traded put price to the underlying. Yes, sir.
Yes, C.
C is
C or A, which one did you say? What is it telling? If you observe a traded put price with this some underlying detail, which of the four? So we know P0.
yes, yes, B is the answer.
P0 is equal to S0 minus C0 minus PVX. So the call price can be derived by, so we have to find C0. Yeah?
Yes, sir.
So C0 is equal to S0 plus P0 minus PVX. So the call may be derived by subtracting the traded put price. Very good. C0 is equal to, no, subtracting, no, it is S0 plus P0. From the underlying, no, it has to be added. Okay, so the call price may be derived by adding the traded put price to the underlying price minus the B is the correct answer.
B is the one, yes, sir. B.
Yeah. So B is the correct answer. Okay. Question number 2. Oh, we have to calculate it. Let's calculate it. Yeah. Okay.
Due to the recent sharp rise in share price, it is recommending that clients consider protective put strategies for 3 to 6 months tenures. If you observe that a 6-month call option at an exercise price of 120 is trading at a price of 22.6, which answer is closest to what you would expect to pay for a 6-month put option with the same underlying terms. So
same underlying. So X is equal to, here X is equal to 120. Yeah.
sir, exercise price is 120. Call out C is equal to 22.6.
C is equal to 22.60. So what do we have to find? 22.60. Sorry.
You need to find P, sir.
We have to find P0, yeah?
Yes.
So P is equal to this present value of this. So C is equal to 22 is equal to 22.6, yeah?
Okay.
Plus present value of 120. Okay. For how many months? Is traded
6 months.
6 months, 3 to. If you observe that is 6 months.
3 to 6 months is 3 months.
No, here it is 6 months. No? If you observe that 6 months CWI call option, so 6 months. So let's discount it at the rate of risk-free rate. Yeah, you do it.
Yes, sir.
Yeah, you do it. Discount it 120.
So risk-free rate is 4%.
4%, yeah. And let me see what is S0. S0 is the same, no, 127. So S0 is 127.50. So plus N. So minus 127.50 minus 127.50.
So this uh, present value is 117.66.
117.66.
Yes, sir.
So how much do we get? So
One second.
yeah, add them. Add
Ah.
22.6 and minus 127.50. So how much is the answer?
12.76. Yeah.
12 okay, see.
Yes.
12.77 means C. Very good. So this answer is C. Okay, let's go down.
You realize that the 6-month put option on CWA shares is overpriced related to the no arbitrage price. Which of the following statements describes what you would do to earn a riskless arbitrage profit?
So put option is overpriced. Means you
So
will
we will
sell.
sell that. S naught plus P naught we will sell.
Yeah, very good. So sell the 6-month put option and sell CWI short, investing the proceeds in a.
Yeah, yes, sir.
Yeah, A looks the correct. I haven't read the other option, but A is so I am so confident that I am not even reading. So okay, sell the 6-month put and buy a call option and borrow the risk. No need to borrow because we are selling short means we are getting money. Sell this and buy a call option. Enter a forward. No need of forward here. Okay. A. Okay.
In her most recent research note on CWA, CSI's equity analyst specifically mentions an increasing CWA's leverage ratio as a reason for her bearish outlook on the stock. Applying the put call parity relationship to the value of the firm, which of the following statement most accurately describes the CWA outlook in terms of option pricing?
Means more borrow. Leverage ratio means more borrowing, more debt. This firm has taken more debt. Leverage ratio means more borrowing has happened. Okay, so means the price of put has gone up. Let's see here. The
Shareholder payoff has improved versus debt holders because they have sold a put option on the firm value that has appreciated.
Doesn't look like they have sold. No, the debt holders have sold the put value.
Debt holders,
Not
yes, not the
yeah,
shareholders.
not the shareholders.
The debt holder payoff has deteriorated versus the shareholders because they are effectively short of put option on the value of the firm equal to the value of debt, which has appreciated in value.
Yeah, but this looks correct.
Yes, sir.
Yeah, because debt holders have sold a short put option and it has gone down, so they are deteriorated. Yes, and let's read C as well.
The shareholder payoff has improved versus the debt holders. No, sir.
So everybody's payoff has decreased. Okay, so B.
Which of the following choices best describes how CSA would replicate a long risk-free bond return using a forward contract on CW and call and put options on CW?
Which of the following here would replicate a long risk-free bond? So again, I PVX.
Short the put option and long call option on.
Should replicate a long risk-free bond, no?
Yes,
using a forward contract and call and put. Yeah. So I bring this again, copy paste. So I copy this and instead of S0, I will control A, control C. I will turn that F0T. Yeah.
yes.
So this question, I write this side. Control V and this becomes F0T. F0T. Now what it is telling?
You have to short the call option and B, sir.
Would replicate a long risk-free bond, means PV. So B, long forward contract, long put option, and short call option B. Yes. Okay. So again, we will have to calculate something. Let's see.
Yes. Observes a 3-month call option on CW with an exercise price of 130, trades at a premium of 3. A 3-month forward contract trades at a forward price of 128.76. Which of the following is closest to the correct premium of a 3-month put option with an exercise price of 130 on CW?
Okay, so we have X is equal to 130 and S is it given as Oh, no, it is F0T.
Forward, sir. We have to
F0T.
F0T. Yes.
F0T. So F0T is equal to 128.76. And what else do we have? R is 4%. So observe a 3-month call with an exercise price of 130 traded at a premium of C. So C is equal to 3. Okay, C is equal to 3. A 3-month forward contract on CWY traded at a forward price. Which of the following choices is best to correct premium? Okay, so we have to calculate the present value of X. So this,
Sir,
okay.
present value of X is 128.73.
Yeah. So what will that be for 3 months
Yes,
at
sir.
the rate of 4%?
Yes, sir. So 128.73. 28.73.
No, it should be only 70 cents interest. Probably there is some error.
4% only now, sir.
Yeah, 4%
So
for 3 months.
1.04 to the power of minus 0.25.
Yeah. So how much are you getting?
Into 130 now, sir.
Okay, so what is the value of this? Okay, let me use the second. Okay, so how much is the present value? So we have to calculate P0, no?
Yes, sir.
So
So
P0 is equal to
3 plus
3 plus
128.73.
1. No, this one is minus. Minus, no.
No, I'm telling the present value of X, sir.
Yeah, so present value of present value of how much is that?
128.73.
128. Yeah, okay. That's why I was confusing. I was thinking that okay, yeah, and minus
128.76.
1
28.76.
28.76. No,
That is the
this is
F0T now.
forward. It is not S0. You have to discount this as well.
Oh, this also have to. Okay.
Yeah, this is not S0, no?
Oh, okay, sir. Okay, sir.
So you have to discount this also, yeah. I think it looks like it is. The answer must be because it is more.
127.50.
Yeah, 127.50. So what is the final value? 0.5. So this is 420. Yeah. The age correct, no?
1 second, sir.
Because this becomes the 423.
Sir, 4.2.
4.2, so age correct. Okay.
Sir.
So our answers are B. One is B, then C, then A, B, C, A, then B, B, A, B, C, A, B, B, A, B, C, A, B, B, A. So, sorry, B, C, A. The correct B, C, A, and then B, B, A. So B, and then B, and A. Okay, so good. You did 100% in this chapter, and you learned it. Looks like
This was the most interesting of all the chapters.
most of the chapter. Yeah, that's right. So tomorrow we are meeting at 5. No.
Yes, sir.
So I will send you invite tomorrow morning for 5,
Yes,
and then we will meet at 5.
Yes, sir.
Okay. So let me stop it here. The recording part first, and then okay.